This is the Note Closers Show, where you get the latest developments in distressed note investing and learn the secrets of how you can control millions of dollars worth of property for pennies on the dollar. Get educated and entertained by someone who has closed thousands of deals and lives to support you in achieving the same. Now, here's your host, CEO of We Close Notes, Scott Carson.
Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closer Show. I'm your host, Scott Carson, and I am excited to have an old friend on the show today talking about what he has going on and what he's doing in kind of the note space and how his business has evolved over the last 5, 6, 7 years. But I want to give a big shout out and a big congratulatory welcome to my good buddy, Tom Braegelmann. So good morning, Tom.
Hey, good morning, Scott. How you doing?
I am doing great. I know it's a little earlier out there in sunny California than it is here in Austin. But it's still you've always been an early riser anyway, knocking stuff out like you do.
Yeah, right. Well, yeah. No, it's another beautiful day in paradise here in California. So it's
And you're up in the San Jose area for everybody.
Yeah, we our office is in Campbell. We also have an office in Puerto Rico in San Juan, but yeah, I'm in San Jose, Campbell area right now. So.
Exactly. So Tom has a company called GCA Equity Partner. You want to talk a little bit about what you're doing, Tom?
Sure. Yeah, we've been doing short-term lending on new construction, renovation projects, some with performing, non-performing notes. And we've been doing that now for about, we're going on 8 years. And it's been quite an interesting trek. We've learned a lot, but we've had a lot of really good success with some of our projects. And yeah, just basically doing short-term. It's really a lending model where we lend to developers and contractors or investors who would like to get involved in any one of those areas.
Right, and you're doing primarily California projects. Is that correct? You're basically coming in and funding the rehab portion of for the most part.
I would say we have almost half of our deals are in California, but we're in about a dozen states right now.
Oh, good.
And Puerto Rico, of course.
What do you love about Puerto Rico?
The people, the weather, very nice. They've gone through some really challenging times here. They still are in the midst of that. My son is down there full time, helping out with FEMA for the last, probably about a month and a half now. And so he gets to see firsthand everything that's going on. But, you know, with that, with adversity, with challenges, there are always opportunities as well. And that's one of the things we've found. We've been able to get to some of the people that really needed help and help them out with some short-term bridge efforts and things like that. So but definitely the people, the culture, the weather, it's been great.
It has been great. I'm a big fan of Puerto Rico too, and they've also got some really cool tax advantages if you're running business down there and do some cool stuff. And it's also a whole lot warmer down that neck of the woods than where we're both originally from. So
yeah, Minnesota.
Yeah. Minnesota, yeah. It's a freezing night now. You can go downstairs, get a pop, and go have some loose cafes. We'll be good.
That's good. We'll go out in our boat and see if we can get a bag.
Yeah, exactly. Now, you have been in the process of getting something major done. You want to talk a little bit about kind of what you're excited about right now that you've just gotten accepted? We were talking about before we started.
Yeah, right. It's our new Regulation A+ fund, which is it's been about 14 months in the works and a lot of time and effort, but we just got notification about 2 weeks ago. We're going to be starting it up 1st of January. And yeah, it's exciting because what it does is it allows us to bring investors in who normally don't have access to some of the really nice deals that the big boys or the high net worth people play in and that arena. And so it offers some opportunities, a $5,000 minimum investment, and so it's just it opens the doors to a lot more people to be able to invest in real estate or in notes in ways that they never were able to before.
Right. Now, this is your one of your this is not your first fund you put together. When we met and we're working together some things, you were putting on another fund together a few years back, though. How is this a little bit different from that?
Yeah, so this would be our third. It's actually our fourth fund, but we'll for all practical purposes, it's our third fund. One of our funds we already have closed on that. We've stopped accepting investors in that one. But the difference is our first one was a California offering, which meant we could have investors from California only, and we could invest in California only. So that was a bit restrictive when we wanted to start expanding. Then we did our 506 Reg D, and that one allowed for us to have accredited and non-accredited investors, up to 35 non-accredited, no advertising, can't promote that at all. We also had the 506 B, which I think I have those right, B and C. Anyway, we have the on that one, it's accredited investors only, and that one we could do some promotions on. So the difference now with this Regulation A Plus is that we can get word out to everyone and share what it is. And as you know, I think you're well on your way with yours, that there is a whole lot of scrutiny, a whole lot of, it's definitely some very high hurdles to get over to get to that point of being approved by the SEC. And they go through everything and anything. You get to prove your track record, prove your history, prove everything that you've done, and prove what you're going to be able to do going forward. So it was a lot of work, a lot of effort, but it's really it feels really good to be on the other side now, where we've been completely approved and ready to go. So.
Yeah, and it's been over a year process for you. Is that correct? Right?
Yeah, it's been close to 14 months right now.
Yeah, and a nice six-figure expenses on it. I'm experiencing that ourselves with our Reg A too. So totally understand that. But that's the beautiful thing is now that it's approved, you are able to go out and solicit, able to market. And that's one of the things. What are some of your plans to market for clients there? You know, I know that you were doing regularly. You've changed things up quite a bit, but are you doing webinars, talking to your existing client base, doing email blasts? What are you doing? Because a lot of people are scared initially that we have on here are new, and they're like, oh, wow, a huge Reg A, that's huge, and I can't do that. But we all started doing individual deals, you know, when we got our start in, right, Tom?
Right. Yeah. So the plan right now, I'm actually working on it with my daughter. Does some marketing, and we've got a couple of people on our team that are real strong in marketing. But I've already started the podcast, the Bank Free Blueprint podcast, which we've been going for probably about the same amount of time as you have with yours. And so we're working on that. But we also, with the approval from the SEC, we also have a lot of broker dealers now that are interested in following us and offering our product, because they know the level of scrutiny that we've gone through, and they know what they're working with. So we are going to be we think we're going to have, based on the signs we see so far, there's definitely a lot of interest from broker dealers to move our product. So it's going to be a little bit of I wouldn't say wait and see, but we're going to ramp it up fairly slowly with our marketing, because we don't know exactly what we're going to be bringing in from broker dealers. We don't want to be to the point where we're holding everybody off and saying, no, we don't have enough deals to get funded. So it's a matter of ramping both up at the same time. So money deals, and you know how the game.
It's like that, you know, it's like this. You don't have too much money and not enough deals. You don't have too much deals and not enough money. So it's a good balance for you. Now, are you still
with the fund? What I've come to learn is that the only thing worse than not having enough money in the fund is having too much money in the fund, right? That draws a return down from everyone. If the fund is not placing the capital as fast, or if it's not regulated so that it gets placed in relation to the deals that are coming in. So,
right. Now, you'll be doing projects outside of California. I mean, in California, but also out of California with the fund, correct? What's your sweet spot that you're looking for? If you had a typical kind of parameters of a deal, what are you looking for?
Our pipeline right now has deals anywhere in the range of maybe 300,000 up to 7 or 8 million is sort of our top end in our deals. Some of those we're funding the entire stack. Some of them we're doing the gap or the mezzanine or bridge, whatever terms we want to use. But we do that where we team up with other either senior positions or other lenders, other investors. So, but we do like some of the smaller ones too. We just haven't been doing quite as many of those in the 75 to 150, $200,000 range. We do like those. They're kind of nice little bread and butter deals. So.
They help you keep churning through things, keeping the money playing and stuff like that.
Yeah, right. And one of the things with our model is we have it's a debt equity model where it's more like a joint venture than a borrower-lender relationship, but it still is a borrower-lender relationship. And by that I mean we team up with developers, borrowers, investors who have the deals, and they want to get more projects done. So we bring more capital to a deal typically than what some hard money brokers would, or certainly more than what banks do. And we're able to offer more flexibility with those active investors who are doing the deals. So it's a great way for investors, the active investors. I always look at active and passive. Active, the one with the deals, passive, the ones with the money. And so we're able to really help the active investor expand their portfolio and grow with additional capital.
Exactly. Now, you've been running a meetup group out there for quite a while. Still running it on a regular basis?
Yes. As a matter of fact, tonight is we've got our it's the second Tuesday of every month at 7 p.m. in San Jose. Yeah. So, yeah, that's exciting.
It is exciting because you've got it's grown from small but very rapid growth. How many members do you have right now as part of it?
Yeah, so I started December 2010, and I think we had 3 or 4 people there, but we're up to over 3,000. I think we're right at about 3,100 members now. That's
impressive.
Yeah, thank you. We get maybe 80, 85, 90 people to our monthly meetings, and then we send out messages, send out information to the other members. So.
So going from 3 to 3,000 in 7 years.
Yeah.
Consistency builds success. Would you agree to that?
Yeah, absolutely. Yeah, it takes it's month after month, but it's great. I really enjoy it, and we get some really good topics, good speakers, and I think people really enjoy it because one of the things we push very hard is collaboration, working together, getting that alignment of interest, so everybody is pulling in the same direction. Everybody does better. If we can help each other do better, it raises everybody to that next level. And it comes from the abundance mindset where there's plenty for everybody rather than the scarcity and fear and kind of nobody can get my deal kind of mindset to, there's plenty out there for everybody. So that's been one of the key reasons I believe that it's been successful.
Well, you've got I think it starts at the top, and you've always had an abundance mindset on things and knowing how hard you work. I remember back a few years ago, seeing how hard you were. I was actually worried about it. I was like, dude, you got to take some time off. And I remember you took it was a trip to Africa. You were gone for a week or two, and I think your son went with you as well. Huh?
It was a little over a week, yeah. Mm-hmm.
And you came back, it was just a different look on your face.
Right. No, that's true. It does, but it takes a lot to get, as you well know, it takes a lot to get a business going. And once it's up and running, you can't pull away too much. And but in the end, it's really all worth it because everybody does better. Every business is good, and helping other people really feels good.
Exactly. I totally agree with that, my friend. What I want to take you back. I always like to ask people where you're at today. What was your first real estate deal? You remember back what your first real estate deal was?
Oh, yeah, that would have been. So I feel like I have 2 real estate lives, right? My first life was starting out at the age of 19 or 20 when I bought my first mobile home, it was a mobile home in Minnesota, and I grew my portfolio, did really well up until 2008 when I got clipped a bit. But the reason I got clipped was I lost focus. I got involved in other business ventures and overseas, different types of things. but yeah, so my first time around, it was a mobile home. Then I got a duplex. I lived in one of the units of the duplex, fixed up the other one, and then switched. And then the duplex next door came available, and I started doing that. And I did it by way of owner financing, which is very similar to some of the things you can do with the notes that you work with. And then again, after I basically lost everything in 2008, 2009, I started over, and in that process, I went through and I did more of the joint venture structure where I brought other investors along. But both of them were without banks. Both of them were with collaboration with other people that were willing to work together. And that was a lesson that I learned, that if we can't do it alone, let's work with somebody rather than feeling like it's not possible to get it done. So, but yeah, that's what it was.
Good stuff. But that's the thing. A lot of people have had that build up, and then 2008 kicked a lot of people in the shins or other places, with a thing. You get people to refocus. And I went through the same thing too. And then refocusing that, you kind of rebuild your stuff up. It's going with the market and changing your kind of strategy and your focus. You got to be solely focused, because if you lose sight of what you're focused on, you can lose everything you worked hard to get, right?
Absolutely.
So let's talk about what you've got your Reg A. Where do you see your market? Where do you see the market being in this next year? I know a lot of people have been asking me that.
Well, I think in California, I think it's, to me, it feels like it's definitely towards the top end, where I think there will be some correction, I'm guessing, within the next 12 to 18 months. But I mean, who knows? But that's what I'm thinking. I don't think it'll be anything like it was 8, 9, 10 years ago. In other parts of the country, I don't think there'll be quite as much of an effect. I think a lot of areas are in the sort of the grain belt states, there just is a lot more stability. It doesn't have all the swings. It doesn't go up nearly as high, but it also tends to not go down as extreme as fast. So I still feel really confident in the market, because, and this goes back to something you just said, with every market, wherever the economy is, wherever anything is going, if we can be very aware of what's happening, we can change our strategies, we can change our techniques, and there's money to be made in every single market. If the market's going up, if the market's going down, if it's slow, if it's fast, whatever it is, it's a matter of being able to switch strategies or adjust strategies enough to be able to go with it and to be able to take advantage of what is happening at that point. So I think it's really critical to keep an eye on what's happening, and then listen to advisors, listen to people who know, who've been through it, who have maybe who have a few scars that can tell you what it was like, and be willing to adjust your strategy. Even though something is working really well right now, it may not always be that way. So being able to shift. And I know that with what you do, one of the things that I've always realized and appreciated with you is that you have that creativity, that flexibility, that knowing how to adjust things so that if a market does switch, or, I mean, you've got so many different strategies in your tool chest that of how to deal with notes, whether they're performing or non-performing, that those can be really powerful in any sort of an economy, but certainly in a turning economy.
Yeah, I appreciate you said that. It's because every market's a little bit different, and like you said, what's going on in California isn't necessarily going on in the Rust Belt states. And whereas I used to buy assets or non-performing notes in California, I had to change my strategy. We bought a lot more this year in Ohio and in Indiana and Michigan, stuff like that. You know, in previous years we bought a lot in Florida, a lot in South Carolina. Yeah. So it just varies on what kind of grown your way, and having your ear to the ground so to figure out what's going on and listening to what the asset managers and things are saying out there. It's important to keep up with it. I've seen a lot of people, and I still see this to this day. A lot of people are still trying to do business like it was 24 months ago. They're still doing a lot of the same things they were doing, trying to find, squeeze blood out of the rock, if they can. They're still trying. We see that here in Austin. I mean, Austin's such a hot market. and inventory's so low and people are just dying to try to do anything, and then they're overpaying a lot of the times. And
very similar to what's happening here. Very similar.
Exactly. I mean, that's the same thing all up and down California. So it makes for an interesting time to kind of pull back from investing here and wait around until that correction takes place and then investing.
Yeah.
So,
right. Well, and it's so easy to get caught up in the, especially for people who are new in the business, to get caught up in the excitement of a deal and to see things only from the potential, the upside. Whereas if we can, and this is what a mentor had told me quite a few years ago, it's take care of the downside and the upside will take care of itself. And so always watching for those risks, always identifying anything that could potentially go wrong and figuring out a way to mitigate those risks. And then the upside will always be there if you can control the risks and control the project to make sure it goes as planned. So.
Exactly. Who are some of your mentors, Tom?
Well, George Antone was the one that had he was really key in my switching over to the lending side of the equation, going from a full-time investor to actually a sort of a lending model. He was big. Gary Boomershine was his partner early on, and I had Gary on one of my podcasts. And he had some really interesting things with wholesaling and was able to do really well in that. Willie Hooks, and then there's always the Kiyosaki, Rich Dad, Poor Dad, that I never went through their courses, but I read the books. And Alex Arriaga is a business partner of mine and a very good friend, and he had been working with that organization for a lot of years, and so I had access to a lot of that information, and so those are some of the ones that come to mind.
Yeah, George. We actually had George on about a week and a half ago, actually on the podcast.
Really cool. Yeah.
Saw him out in Cincinnati for the big Cincinnati, Ohio RIA Expo. He's teaching there, and we were visiting, talking about some of his transitioning and things like that too. We ran into John Hurley. John's the buyer behind all the Kiyosaki stories.
Oh, okay.
So John's been a friend. I've known him for a few years as well. And then Sharon Lecter, who's a co-author of the book as well. So we have a lot of the similar mentors out there and similar mindsets that keep up with our wacky brains, right?
Right. Exactly.
Well, you've come a long way in the last 7 years, actually last 9 years, since you took it in the shorts like you talked about and had lost some things there for it. Where do you see yourself in the next 5 years?
I think we are at a turning point right now where I think we are going to be having we're moving up to a little bit bigger size projects. We see ourselves growing from that perspective. I think we put together probably about, what was it? We just did the numbers, $210 million worth of deals over the last years. And I think that we're going to be able to do that pretty quickly here in the next year or two. Again, we'll be able to double that, I'm sure. But so that's the business side of it. The other thing that I personally want to do is be able to get out there and do, I love mentoring. I love being able to help other people get to not have to make mistakes, that I made, or really helping them grow and expand. And so I see myself doing more of that, and probably getting to the point where I can start taking a bit more time off as well. I think that's right around the corner. So my son is in Puerto Rico full time. My daughter's in Colorado. I'd love to be able to spend more time with both of them. And although we do a lot of things already, but still would like to be able to do even more. So so that's what I see.
Well, that's a good thing, because I think there's not enough people that are actually doing the business that are actually not teaching it or trying to help people, mentor people. You've always got a big heart you don't have to be around you 10, 15 minutes to realize that, and especially with how passionate you are with your networking group or the meetup group there that takes place there in the San Jose area and stuff like that, growing that, and just seeing how people you just come to you. I mean, you're just a great giving guy. You do a lot. I know there's been times where you've had investors invest in something that you weren't in control of, but you also took some of your own funds to make sure that they're made whole because you felt accountable for that. And really taking care of your investors. And we didn't talk about that. I remember I've always admired you for that, because you're like, we're going to take care of these people and help people avoid mistakes, and everything worked out fine in the long run. But you've got a big heart that is important to everybody.
Well, thank you. Yeah, it's one of those things where short term it would have been so much easier to just say, well, that's just the way things go. But in the long run, to run a business that's really going to help everybody and really grow and expand the way it can, I think it's about the collaboration, working together, and to be able to stand behind things, even though it was things out of our control, whatever it might be. I think we still have the ability to stretch and really make sure that everybody comes out in the end in a way that's positive for everyone. So thank you for recognizing that. Sometimes that can be a challenge, but it's part of good business, and I know that's how you operate as well.
You always take care of the people. You always take care of them, and sometimes that means you're not doing things that you want to do, but you always make sure so you can do bigger things in the long run. Yeah. So you can open up a Reg A fund and on good nature and doing some great things and closing out projects and stuff like that. So you talked about bigger projects. Are you going out and buying larger assets, or are you buying portfolios or working with banks and portfolios? Or are you doing more the aspect of just funding portfolios and investors? What's kind of things?
Yeah, at this point, it is still where we are funding the developer contractors with bigger projects. Yeah. We've got one in Myrtle Beach right now. That one will probably be in the $80 to $90 million range once it's all completed. It's 3, or depending on how we do it, 3 or 4 phases. And I mean, we've got a handful of them in the hopper right now where we're ready to roll as soon as the capital starts coming in even faster than before. And so rather than getting hundreds and hundreds of small deals, we'd rather have maybe a less in quantity but higher value. I do still think, though, that we're always going to have a portfolio of smaller projects that are just everyday kind of base hits. Not everything has to be a home run. So.
Well, it's a good thing. You got your bigger project talking about, but you're still doing things on the side there with some of the smaller projects and other things like that. And I think a lot of investors, when they get the commercial bug or the bigger project bug, they get so tied into one deal and focus everything on that. They fail to keep bringing home the bacon with a regular, residential or their note deals or whatever that might be. They get so big on one, they forget about the others. And a lot of times, you and I both know these commercial projects can take months for due diligence and other things coordinating to get them approved, right?
Yeah, exactly. And along with that, there's the diversification, the going in different parts of the country, going with different size projects, going with different types of projects. That's all diversification within a fund. That's what one really wants, because if one of the sectors starts not doing as well, the others are there to keep it. And diversification and spreading risk is really what a fund is about. And so that's part of the management of that.
All right. Question for you. With your podcast, I want you to say the name of your podcast and things like that here in a second here too. But have you already, in the time that you've had your podcast, but you're already starting to see results from the marketing from that, or people getting word of what you're up to?
Yeah, well, there is some. I haven't been doing a lot of pushing or promoting of the podcast. I still get to learn how to do some of those marketing things, or have more people on my team to be able to do that type of thing. But one thing that if nothing else, I've certainly gotten to the point where I feel more comfortable getting in front of a video or getting in front of a microphone. And man, I can't tell you how 7-8 years ago, how if I had to get up and speak in front of anybody or do something like this podcast, it's like I couldn't even say my name. It would be so ridiculous.
I do remember how nervous you used to get.
And it makes absolutely no sense. It just logically, it's like, why in the world is it that way? But it's a lockup. It's something that happened to me, and so it was my way of forcing myself to get out there and be more well, really practice, I guess, and realize that I'm not going to die for if I'm in front of a camera or speaking in front of a group. But yeah, so that has been probably one of the bigger benefits. And we do get a lot of good comments about the podcast because we like our meetup group, our real estate investment group. The purpose of the podcast is really just to bring a lot of good content, a lot of good information to people so that they can increase their business or improve their business or grow whatever it is that they're aiming to do. And so, yeah, it's been a good experience, and definitely plan to continue it. And I'm excited for the next podcast interview I get to do.
Give everybody the name of your podcast so they go out to iTunes and Stitcher and all that good stuff and subscribe to it, because you've got some great things. And I love what you're doing with it, is you're doing the recording. You're not doing it live, or you're recording it and then uploading it to Facebook and sharing with that. And you had some really great speakers and guests on there, because I've gone back and watched quite a few of your episodes, or as they pop up, I definitely jump on and listen to them. So
yeah, thank you. Yeah, it's called the Bank Free Blueprint Podcast. And the idea being that we can do a lot of things with active investors and passive investors working together. It can be done without a lot of the hassles of banks. And yeah, it's a very collaborative platform where we try to bring in resources from speakers. And so, but yeah, just going to Stitcher, SoundCloud, iTunes, any one of those, and you can go on. Or if you go to tombraegelmann.com, it's a website that we're just finishing up, but there would be episodes on that. But yeah, definitely feel free to jump on.
Stephanie Goodman says hello, by the way. She commented on there and says she's suddenly got a craving for pickles, remembering how big a fan of pickles you are, right?
All right. That sounds good. Hey, Stephanie.
Good stuff. The things that we know about everybody from spending time and traveling and hanging out. I've enjoyed coming out and spend time there in your offices there, and I'm very proud of all the things that you've accomplished, and glad to see you doing so well and helping so many people out there, not just through the networking, but you've got a big giving heart. You're helping a lot of investors get things done. You're helping a lot of investors make some great returns on their money, put their lazy assets to work on some projects, and being a facilitator of success.
Yeah, thank you very much, and likewise, it's been a real pleasure working with you, and some of the different projects we've worked on. It's some very interesting things.
Right. For those that are watching, Nicole's put the link to the podcast in the comments, along with a link to the website there for GCA as well for you guys. Any questions for Tom before we let him get rocking and rolling on this Tuesday morning, Tuesday afternoon area there for you? I see some people on here saying they understand they funded in our project, wondered why they didn't go to the bank, but realized it was easier to get it done with other people's money. 9 or 12-month term. We got a question. Somebody asked, do you have a product that works for non-performing note investors in the first lien space?
Non-performing first lien. We can be flexible enough to do something like that. That's one of the things in Puerto Rico. There are some non-performing notes there. We have a really good relationship with a couple of attorneys down there that are helping some of the investors that got clipped with where the banks would pull their financing. The businesses were doing really well. The real estate was doing really well, but the bank pulled out, and so the financing was gone. And so now we're helping them get some of their properties back by way of buying the notes. So they're really considered performing notes. They only turned non-performing because there was no place for the borrower to send the money to anymore once the bank stopped accepting payments. And so, but yeah, there definitely are some ways to structure so that non-performing first positions could be worked out.
Yeah, there's a lot of non-performing down there with Doral Bank and Banco Popular having a large lending platform down there. I mean, we've seen portfolios out there where they were, banks were wanting to move stuff, 6 months ago. And I said, well, wait, I don't think we've come down far enough. And we've seen the values drop a little bit of some stuff, residential, commercial projects there as well. You see that if you're asking for it there. But I think you've got the right idea, having somebody there on site to take a look at everything and really facilitate that.
Yeah, and there too. It's always nice to see that, especially when you can prove that the business and the people were doing really well up until they got pulled, until the bank pulled out. That's where we feel really comfortable continuing to work. And what happens is they're able to get their notes back at such huge discounts. They can get them back at 30 cents on the dollar, 40 cents on the dollar of what they originally owed. And now their business is going to do that much better because they have a lot more cash flow to work with because of a lot lower payments.
Yeah, a lot of flexibility there when you get your underground debt back at 30 cents on the dollar.
Yeah, right, exactly.
Good stuff. Well, Tom, I don't want to take too much more of your time. I want to thank you for being a part of the Note Closer Show podcast. Once again, guys, go out there and check out the Bank Free Blueprint podcast with him. You can check him out at tombraegelmann.com. Find out more of what Tom, what's your website for GCA there?
GCA Equity Partners.com or Secured Real Estate Income Funds, plural, Secured Real Estate Income Funds.com. Both of those would be ways to reach me.
Awesome. Well, hey, bud, thanks for joining us on here. You have a great afternoon, and we'll see you at the top, bud. All right?
All right. Thank you, Scott.
Thanks, bud.